Hello, and thank you for joining today's webinar. My name is Gayathiri from Index One, and today I am joined with Arun Soni, co-founder of phaseinvest, and Tim Fortier, Chief Investment Officer of Drawbridge Strategies. Today, we will be exploring personalized investing through direct indexing. Direct indexing promises several benefits from low expense ratios to tax loss harvesting. We will discuss these benefits and how direct indexing is the next big thing shaping the investment management space. Before we start, let's go back to the basics. Tim, could you briefly describe what an index is?
Sure, and thank you. I think for this definition, I'm going to refer to a white paper that was written back in 2015 by Andrew Lowe, who is a professor of finance at MIT. And in this paper entitled "What is an Index?", he basically sets forth three criteria. One is that the index must be rules-based. So in other words, a predefined set of rules are used to define the selection process. Number two is that the index must be transparent. You must be able to see what the constituents are within the index. And three, that it must be investable or replicable. So basically something that's easy to replicate, in the real world. It doesn't do any good to have esoteric securities that are, marginally tradable or something like that. So again, basically being very easy to invest in. So those three criteria is what he used to set forth what is an index.
And what do you think are some popular indices that are being sought
Probably the
after?
most famous in the world is the S&P 500, right?
Yeah.
It's the proxy for the U.S. stock market, basically large cap U.S. But if you look throughout the world, there's the Nikkei, there's the Euro stock, there's the MSCI World. I mean, there is a slew of indexes that are available for investors or that represent various segments of the market.
And Tim, if we were to look at the construction methodology of the, let's say, vast majority of the indices, I mean, it would be fair to say that they use market capitalization as the weighting mechanism, either solely or in conjunction with some, let's say, factor weights if it's a smart beta type index. But market cap seems to be the most heavily preferred method because it's an accident of history. The first
it literally is. This goes back into the 1920s when they were constructing the transportation average, and the precursor to the S&P 500 came about with this idea of, well, let's use market cap as a way to construct it, and of course that is now carried through to current day.
Yeah.
So basically 100 years.
And market cap was an improvement to the price-weighted mechanism that is in the Dow Jones 30, as well actually in the Nikkei as well. That's why in institutions, you'll use topics rather than Nikkei, but it's such a popular index that is still quoted. So
yeah, but it comes with it, though, now, as we were seeing, particularly in the current market, its own inherent problems. And so if you're using market cap, as we know, last year was the year of the Magnificent Seven, and we have a U.S. market now that's dominated by, I think, the top 10 stocks in the S&P 500 are now about 31% of the total market capitalization. So an investor who is buying the S&P 500 index is actually getting a very heavy concentration risk in 10 stocks. So 30% of their investment is invested in 10 stocks, which isn't as diversified as one might think. One's thinking I'm getting 500 stocks. Technically you are, but by exposure you aren't.
Exactly. So, I mean, I think actually maybe the concentration is even more, but so that leads to one particular side effect of market capitalization based weighting. I mean, it may be that market cap weighting is fine in a particular market where there is not lumpiness in a certain segment. There's not some extreme large caps, then a big, a middle, and then some tail. But we tend to see that it seems to be the case everywhere. So that leads to concentration. So you mentioned the concentration risk in a few securities of the total weight of the portfolio. But it gets compounded if they are from the same sector, which is in the case in the US. They may be from different sectors technically, but we know they're all sort of technology, and the sentiment that's going to drive them is going to be the sentiment on high growth tech stocks. So now you've got high concentration in a few stocks, and then they all are going to be driven by the same factor. So you're doubling your concentration risk. And not to say, I mean, the S&P has returned, so there's nothing to say that it can't happen again. But the main point is that does that align with your or with an investor's risk exposures preferences? And the point is that the popular indices may not be right for everyone at every point in time, because of the concentration risk can lead to extreme drawdowns, as we saw in 2022. The S&P 500 fell 20%, and if you are, if you have a retirement portfolio, you may not want a big chunk in it. So that's why it may not be right for everybody all the time. And direct indexing offers a solution to improve upon index investing via aggregated vehicles such as ETFs and index funds in a few ways. So if we were to define direct indexing, it's basically investing in the same index as you wish, for example, S&P 500, but you actually would buy the underlying stocks rather than an ETF or an index fund on that index. And what does that give you? The most popular benefit cited for direct indexing is the return uplift, which a lot of research in the US market suggests up to 2% return per year through tax loss harvesting, with offsetting capital losses against capital gains to reduce the taxable income, which effectively gives you an extra 2% return. And then personalization. We live in this era of customization, mass customization, so you can customize the index. And it sometimes makes perfect sense. You if you're a senior executive in Apple, you may wish to invest in the S&P or US large caps, but you may not want Apple because you already have a lot of direct exposure in Apple. So direct indexing lets you then tweak that risk preferences to suit your own risk appetite. And then the other popular one is ESG. And then the third one, which is important to institutions, but even to individuals, will be transparency of shareholders' rights. Because with direct indexing, you own the stock, so you don't outsource your shareholder rights to an intermediary, such as in the case of ETFs. So Tim,
Yeah,
what
going back to customization, you're exactly right. I mean, what's often cited is either ESG or personal preference, which usually encompasses simply tweaking an existing index. So you take the S&P 500. In your case, you throw out Apple. Maybe you throw out companies that you feel are, not environmentally favorable, what have you, and that's the end of the discussion. But if we go back to what I said at the beginning of what is an index, there really is no limitation. You can build robust strategies that produce higher returns through this implementation of smart factor weightings and so on, that produce superior higher returns with lower risk. And if you start thinking outside that box, that opens up a whole spectrum of new possibilities of what you can do with an index. Again, don't limit yourself to what is been predefined for us, but let's build new and better indexes that actually perform better, that get an investor a more desirable outcome, which I'll define as a higher return with lower risk.
So basically what you're saying is that direct indexing comes with many benefits, but it's not been, let's say the benefit extraction is not fully optimal, right? So on the tax loss, yes, but tax loss is let's say it's a commodity, because it's really a tech solution. You just need to know the tax rules per domicile, and then need to have a smart platform algorithm that will optimize each account's tax optimization, but there are broker softwares that do it. There are custodian softwares that do it. Actually, it's not even hard to do it yourself, right? So that's the tech part. And what we like to say is that constructing a better index or reimagining a better index for that particular risk exposure is the fin part, which is missing in the fintech implementation of direct indexing, if we have to actually use these terms.
Yeah, I mean, I think the next frontier here is, as you just said, a lot of what has been done so far in direct indexing is technologically based. I mean, it's no different than, we saw a plethora of robo wealth advisors, but what did they do? They latched on to not so modern portfolio methodologies and just did it ad nauseum, where everyone was doing the exact same thing. I think the opportunity here in direct indexing is, as you say, to reimagine the index, to build a better index and not just limit yourself to what's commonly available off the shelf, because I think that is very limiting in terms of what the potential is.
So I think the opportunity is that to move from fringe personalization, where you're just tweaking on the margins by including, excluding securities, to full-blown personalization, to repeat and reimagine an index from the base up. And just to give an example, which means we need to think about what do we do when we invest? We extract risk premium, which is the risk return associated with taking a risk, like value. If you invest in value stocks, we are taking an exposure to value. What we will receive will be the return associated with high value stocks. Same for momentum, dividend yield. And in fact, even when people invest in the S&P 500, we don't like to think of it this way, but they are actually extracting the risk premium of size, because the S&P 500 is what the largest stock gets the highest weight in the next one. So basically, market capitalization is the factor. We just don't think of it this way. So even if you have to use that as a defining metric for construction, you can actually imagine an index that will be better for direct indexing, because you could capture exposure to US large caps, which is what S&P 500 offers, via a market cap based attribute, but perhaps build an index of 50 stocks. It'll be easier to direct index and manage. So again, one could reimagine just the same construction methodology. But if we think about all these various risk premia, we like to think of it that the market is an ocean with all the securities floating around, and each risk premia attribute, like value, size, momentum, dividend yield, is an island where the like-minded securities come together. Of course, each security has membership of multiple islands, because it's not like you're only dividend yield or only value, you're a bit of everything. But if you make it into that island of high dividend yield, then there is a return associated with harvesting the fruit from that island. And does everybody do it with the same efficiency? And I would say no. So if we take dividend yield, continuing with dividend yield as an example, so we have DVY and VYM as the two popular ETFs based on underlying indices, whose objective is to produce portfolios with high dividend yield stocks. But as investors, we want dividend yield, but we want to ensure that the risk premium that it extracts is optimal. We don't just want the yield, we want the yield plus capital growth as well. And they are both based on market capitalization as the weighting mechanism. One has 99 stocks, the other has 452. That is really too large for direct indexing. But if we were to postulate that, well, that's the return in the market because both their return patterns are quite similar, we'd say an alternative framework could be the following. Take a universe of stocks that have grown dividends consistently over the long term. That would be also the same for the other two ETFs, indices. Then filter in the ones that have high payout ratios, again, probably similar to the others. But dividend yield being a special implementation of a value strategy is going to be subject to the same weaknesses that potentially lots of value traps will enter the portfolio. And this is where we believe reimagining an index where focusing on not picking the value traps can make a difference on the capital growth. And as an example, if we look at the return on these 2 years, so we know that value had trouble in last few years, but 2022, 2023 are 2 difficult years for dividend yield strategies. And of course, you won't extract a higher risk premium than, let's say, momentum or the size, which is the general market exposure. But DV-wise, calendar return on 2022 of 1.8 and 0.11% on 2023 is not reflective of the risk premium that could have been extracted from the dividend yield return island. We believe a much higher risk premium existed, and that could make a big difference. And that's what we mean by better indices through completely reimagining the index construction, which means completely everything from the starting universe to the security selection to the weighting of the securities in the index. And that makes a huge difference in the outcome, because we believe dividend yield strategies can not only deliver dividend yield plus capital growth as well.
Yeah, and I think it's important for viewers to recognize that, it's these incremental, it may appear small in a given year, but those kind of additive gains compounded over time can mean significant difference in the end results. So it's that edge you gain from that better construction compounded year after year, whether it's measured in, smaller drawdowns or added returns, that will make a big difference over, periods of 10, 15, 20 years.
And I think as when we started, Gayathiri mentioned that the indexation, the future or the next move is direct indexing, and it's not, it's already quite entrenched. I mean, it's the fastest growing indexation vehicle in the US. It's growing faster than ETFs. And there's over 800 billion already being managed through direct index accounts and portfolios. So it's not as if it's just very, very nascent, but it has a lot of room to grow. And with this entire discussion of better indices, one advantage is that one can only buy the ETF that's available in the market. And the ETF is going to be dependent on with which index company the ETF issuer has a relationship. And let's be honest, that's why you'll see ETF issuers tend to work with 2 or 3 favored index companies. And when they have to build a new ETF, they'll end up picking from that index family. But with direct indexing, you're not hostage to any index company. You can choose the index that suits you the best, whether you construct it yourself or you choose from any of the new providers. And ETFs were a very good innovation. They democratized access to inexpensive index investing, and direct indexing is, I believe, the next generation of index investing. And with advancements in trade execution, I mean, there's zero commissions trading for individuals in the US. In Europe, it's low as well as zero. And then the second one is fractional shares, where even small accounts can direct index because you can buy parts of a share. So it really, when you put this all together with the benefits, it really shows that direct indexing is a solution for everyone.
Yeah, and I think that's a really great way to sum it up. I do agree with the fact that direct indexing is, rekindling and reconstructing the way that index construction is done. So, yeah, looking forward to what that trajectory looks like this year and onwards. But for now, that concludes our presentation today. We hope you learned something valuable about the rise of direct indexing strategies and how clients can leverage from its many benefits. Please feel free to reach out to us with any questions you may have by visiting our website or by sending an email to one of us. Thank you, and we look forward to seeing you in our next webinar.
Thank you.